Hey guys, welcome back to Andrew Invest. Last week was a huge week for earnings with lots of major companies reporting, including many that I own. I was really impressed with all of my companies' reports, to be honest. Even Crocs, who fell nearly 20% after the market didn't like their Q2 forecasts. I actually ended up buying 3 more shares in the company, and I also bought 5 more shares in Google. So today I want to take you guys through some of the key takeaways from these companies' earnings reports and explain what convinced me to buy more of their stock. If you guys stick around to the end, I'll also give you a full portfolio update and show you how my portfolio is going. But let's start off talking about Crocs. So Crocs isn't necessarily my biggest holding, but it is one of the ones that gives me the most pleasure to follow because I actually end up keeping tabs on people in public on who's wearing Crocs, and the more times I see people wearing Crocs, it convinces me that the investment is a sound one, even though I probably shouldn't. It is quite a fun game to play. I also am really impressed by the figures coming out of the company with them absolutely smashing earnings, and even though they did that, the market sold off nearly 20% because of the Q2 guidance, as I mentioned previously, and I thought that was rather short-sighted, with the company actually raising their full year forecast for earnings and revenue. As a long-term investor in Crocs, I saw this as a perfect opportunity to buy the dip. I'm not just a day trader, so in the long term, this company will do well, in my opinion. Also, in this recent CNBC interview with Andrew Rees, the CEO of Crocs, he gave a perfectly reasonable explanation for why the Q2 guidance is not as high as what the market was expecting. So let's go ahead and listen to that now.
That I was looking at the numbers, it looks like revenue guidance was a little soft, but earnings guidance was very light. And so are there higher costs in the business? Is it the cost of that Hey Dude acquisition? What's going on the cost front?
Yeah. So I think investors are definitely focused on Q2 guidance, right? But let me first start. What we actually did was we raised the full year guidance, right? We're going to grow double digits, and we raised the growth rate that we anticipate for the year. We also raised our profit expectations in terms of we had previously provided 26% profit. We said we're going to be between 26 and 27%. And if we look at the full year, we're going to grow double digits. We're going to have incredible levels of profitability. We're going to have very strong cash flow. We'll further improve our balance sheet by paying down debt. And so I think it's a great picture. I think what investors are focusing on is that Q2. And really what's going on in Q2, it's not a softening of trajectory of our brands. It's really about compares to last year and pipeline fill for Hey Dude. So if we focus on last year for a second in Q2, because of the Vietnam factory closures in 21, we had light shipments for wholesale in Q1, and a lot of that pushed to Q2. So we're up against that from a Crocs perspective.
Sure.
And from a Hey Dude perspective, we're up against pipeline fill, where we shipped a lot of brand new customers, very large amounts of product to stock their entire chains, which was hugely productive for the broader distribution of Hey Dude. But it's super hard to comp that this year. So It looks like we're slowing down dramatically. But if we focus on consumer takeaway, it's not slowing down at all. So I think that's what the street is getting a little bit sideways on. And in terms of profitability, look, I think last year we had a 30% EBIT margin in Q2. We're obviously not going to comp that. That was due to really buying Hey Dude and being able to ship a lot of product very quickly, but we hadn't had the time to build the infrastructure, which we knew we needed to build within Hey Dude. And frankly, that infrastructure is what's going to allow us to grow that brand, hugely over the next period of years. So I think it's a little bit of an overreaction. We feel super confident about our year and super confident about the long-term trajectory for our company and for our brands.
So what Andrew Rees is effectively saying here is that analysts had expected the Q2 2023 figures to be much higher than what's realistic because they were basing the figures on the Q2 2022 figures, which had been massively positively impacted by various different factors in both Crocs and Hey Dude. So if we look at the figures themselves, we can see that the second quarter of 2022 earnings per share figures were $2.6 per share, whereas the guidance for this Q2 of 2023, the guidance was around $2.9 per share, which is significant growth on last year, at least 10 to 12%. So the market is being a little bit panicky with the stock here, in my opinion. If we look at the Q1 figures, the earnings per share over doubled from last year, from $1.22 per share to $2.42 per share, or just under doubled. So I think this is really impressive performance by the company. Q1 is usually quite a weak quarter for the Crocs business because obviously with cold and wet weather, people don't generally want open toe shoes. These factors traditionally lead to lower performance in the Q1 of each year, with free cash flow figures doing a lot better for the rest of the year. And that explains why the company has paid off less debt than usual this quarter, with the debt going from $2.24 billion to $2.19 billion, so about $50 million paid off. I do believe that the company will start to accelerate these debt repurchases for the rest of the year, although there is also a focus on share buybacks that I would prefer that the company doesn't worry about until this leverage is reduced somewhat. Overall, the figures for the company are really attractive, with the free cash flow yield being 7.71%. One measure I like to use to measure whether a company is good value in the market is comparing the free cash flow yield, which is effectively the interest on a stock that you have, to the interest rate on US government bonds, depending on the time period that you want to invest for. So let's say that I have a 10-year investment period. The yield that I can get on a US Treasury for that 10-year period is 3.42%. If we compare that to Crocs, it's over double that. And this cash flow yield is significantly better than most companies in the S&P 500. I really think that this is an attractive valuation. It's also trading at 8.86 forward earnings, which is absolutely unheard of in my opinion. So with figures like that, I'm actually tempted to put a little bit more money into Crocs, potentially buying a few more shares. I also bought Google this week after earnings. It beat on both revenue estimates and earnings per share, and I was fairly impressed with the report, although there were definitely more parts of it that I was less happy about. So the key takeaway from the report for me was that Google Cloud had its first ever profitable quarter. That's the first time Google Cloud has turned a profit in over 15 years now, so I think that's an impressive achievement in itself. But if we look at AWS as a comparison, it currently effectively subsidizes every other division in Amazon. It's a huge moneymaker for the company, and it's 10 times bigger than Google Cloud. So that gives Google Cloud a huge amount of growth room to effectively expand, and I do believe that it will become a giant money-making machine for the company. Google currently sits at a very attractive valuation because there are a number of fears by investors that ChatGPT and Microsoft may combine to steal a large portion of Google's lucrative core search business. And whilst that might be true to some extent, it wasn't actually reflected in the figures for revenue or earnings for Q1 this year, and they were significantly better than last year, whilst also beating predictions by analysts. I also think that Google's Bard, although whilst it's a way behind ChatGPT currently, will be significantly improved by Google, who owns DeepMind, the main competitor to OpenAI, in the coming quarters, and I don't think that Google will completely lose out. If we look at the numbers for Google, it's trading at a really attractive price, with forward price to earnings ratio being 17.8 and the free cash flow yield being 4.5, which is still significantly above that 10-year treasury yield that I mentioned previously. The company also has very little debt and a huge amount of cash. It just authorized $70 billion worth of share buybacks, which at this price I think is a really good use of the money. One thing from the report that I wasn't a big fan of was the fact that the company is still struggling to get a grips with its costs. So if we look here at the stock-based compensation, it is still going up year on year and quarter on quarter. It's outpaced by the free cash flow, but the fact that they can't get to grips with the stock-based compensation when many other big tech companies have is slightly concerning to me. I should also mention that by buying Google, I'm effectively lowering my cost average because it is currently sitting at a loss for me. But with that note, let's just get straight into the portfolio review. So this last week has been a pretty good one for me. The individual stock portfolio has gone up significantly, although the ETFs have kind of disappointed. Most of my stocks are now sitting at a profit, especially with that large bounce from Meta, whose performance I was pretty impressed with from the earnings. Next week, Apple reports, so I will be sure to do a video on that. I've also done a few shorts on the earnings from this week, so feel free to check those out if you want my immediate reaction. And if you enjoyed this video, give it a like and hit subscribe, and I'll see you guys next time.